Is value investing actually dead? Recently, a dramatic claim has been doing the rounds. People say value investing is over. They argue that liquidity is all that matters now and that valuation is a relic of the past. Some even point to Warren Buffett's large cash pile as proof that rules of the game have changed forever. That is a significant claim in my view. So instead of reacting to headlines, let's slow this down a bit and unpack what these words actually mean. Because when people say value investing is dead, they are often mixing up several completely different ideas. Let's be clear. Value investing doesn't mean buying cheap stocks. It doesn't mean low price to earnings ratios either. And it certainly doesn't mean ignoring growth. At its core, value investing is quite simple. You estimate what something is worth based on the cash it can generate over its lifetime, and you try to pay less than that amount. That's it. That's value investing in a nutshell. Let me give you a very simple example. Imagine you are buying a rental property. The property generates £10,000 a year in net rental income after costs. You believe that income is stable and that the property will still be rented out in 10 or 20 years. Now the question is quite simple. What price makes sense to pay for that stream of cash? If someone asks you to pay £500,000 for it, you might walk away. If they ask £200,000, you might lean in. That judgment, weighing future cash against today's price, is value investing. If you apply the same logic to a listed company, nothing changes. If you buy a high-growth technology company, for instance, because you believe its future cash flows justify today's higher price, that is also value investing. This so-called value versus growth debate is largely a labeling error. The underlying logic is identical. Now let's talk about valuation. Valuation is not about predicting where a share price goes next month. Valuation is a sober estimate of what a business is worth today based on a few things. How much cash it generates, how stable those cash flows are, the strength of the balance sheet, its competitive position, and how long those advantages can actually last. You can disagree on the assumptions, you can get the maths wrong, but the process itself doesn't stop working just because markets get excited. Now let's talk about liquidity. Liquidity is simply the amount of money flowing through financial markets at any given time. When liquidity is abundant, prices can rise even if fundamentals don't change. We have seen this many times in market history. Liquidity explains momentum. It explains speculation. It explains why prices can move very quickly. But liquidity doesn't explain where the long-term returns come from. This is the key distinction many people miss. Liquidity drives prices in the short run. Valuation determines returns in the long run. Saying valuation no longer matters is like saying gravity has stopped working because planes can fly. Eventually, the underlying reality reasserts itself. You also hear the argument that because gold is at record highs, value investing must be finished. This is a misunderstanding. Value investing doesn't say assets without cash flows can never rise in price. It simply recognizes that they do not compound internally. Gold doesn't reinvest its profits. Its price depends entirely on what the next buyer is willing to pay. That doesn't make it useless at all. It makes it different. Rising gold prices tell you something about inflation fears and real interest rates. They don't tell you that the cash-generating businesses have stopped being valuable. Finally, let's come back to Buffett. He has warned about inflation and currency debasement for decades. This is not a change in philosophy. His answer has always been the same. Own productive businesses with pricing power that can protect purchasing power over time. Holding cash when valuations are unattractive in certain parts of the world is not confusion. It is discipline in my view. At very large scale, finding opportunities big enough to matter is quite difficult, but the rules of the game haven't changed at all. So is value investing dead? No, certainly not. What dies periodically is patience. Value investing doesn't stop working in liquidity-driven markets, it simply stops being fashionable. These are not the same thing. Liquidity cycles come and go, cash flows endure. So the next time someone tells you valuation is over, ask yourself one simple question. Are they talking about next week's price or the next decade's return? Because those are not the same thing. If this helped you clarify how investing actually works, please do feel free to subscribe, and I'll see you in the next video. All the best.